welcome to the New Yorkers. I'm Shereen Bhan, and we're in conversation with Russ Koesterich, the Global Chief Investment Strategist at BlackRock. Not quite New York, we're sitting in San Francisco, but thank you very much for joining us on CNBC TV 18. Let me start by asking you about what the outlook is as far as equity markets around the world. We finally heard from the Fed. We don't know whether it's going to be September or December. A rate hike is coming, so that suspense is sort of now beginning to sort of, wear down a little bit. But what's the impact that you see as far as equity markets go?
I think the short term, the impact is not that large. We normally see some increase in volatility around an initial Fed hike. That's likely to be the case this time, given the fact that we are currently at very low levels of volatility. So to some extent, you're simply reverting to the mean. But I think the reality is interest rates are still generally low. We have slow but steady growth in much of the developed world. And we're in an environment where equity markets can move higher, albeit with more volatility than we've seen over the past several years. So
when you talk about more volatility, what should we expect? And there's been so much focus on when the Fed actually moves and not enough focus on what happens post that move. What do you expect if it is September? And of course, we're clear that it is going to be a gradual move towards normalization. What should we expect post that first hike?
Well, post the first hike, you are going to get some volatility. Well, that normally manifests itself in some correction, but not a particularly large one. There's some variation, but historically figure about 5, maybe 10%. That would be a large correction. And if we have the hike in the context of rising inflation expectations, in other words, that real rates are not rising as fast as nominal rates, that normally mitigates the impact of the hike. I think the reality is, and you hit it perfectly, what happens afterwards is more important than whether it's September, October, or December. And what reassured investors last week was the fact that the Fed lowered their expectations for hikes in 2016 and 17. And what that tells investors is that even when you have liftoff, this will be a very gradual tightening cycle, and it shouldn't be an insurmountable obstacle for equity markets.
Okay, so if you see volatility, what would it mean specifically for emerging markets like India? Because there's always concern on whether we are going to see large capital outflows out of emerging markets. Do you anticipate that, or do you believe that that fear and that concern is exaggerated?
Well, I think that the concern is largely baked into the price. We've already seen a significant correction in emerging markets over the past month. They've been down around 10%, some markets more. And the reality is that many emerging markets, including India, are much better positioned to withstand a Fed tightening cycle than was the case a few years ago. Current accounts are generally lower. Fiscal deficits are generally lower. We have significant reserve balances in much of Asia. And then the final point is we've had the benefit for many emerging markets of lower oil prices, which have created a much more benign environment relative to what you've seen in 2013 or even 2014.
And do you see that continuing as far as oil is concerned?
We believe that oil is in a trading range. We don't expect a significant backup in price, but I also don't believe oil is going to fall significantly below $50 a barrel. Oil is really caught right now between rising international demand and the potential for more supply, both from U.S. shale producers and also potentially from Iran, should a nuclear accord be reached with the United States.
So how would you then see 2015? Do you see the markets correcting sharply in 2015 in the backdrop of the Fed moving finally, whether it's September or December, and the kind of correction that we are seeing in emerging markets, specifically in markets like India, for instance? Do you see that correction deepening significantly?
I think you may see more downside, but I don't think it's going to be particularly significant unless something happens that surprises the market, whether that comes from the Fed or perhaps an event in Europe. But I think, for the most part, the fundamentals
Has
are
Greece
relatively...
been factored in?
Well, Greece has not been factored in. Now, our base case scenario is there is no Greek exit. We think that the situation will be resolved, albeit with probably a temporary resolution. If there were to be a more significant event in Greece, then I think you would see some volatility around that. But the point I was going to make is that generally the global economy, while not in great shape, is doing reasonably well. Inflation is low. Interest rates are low. We expect some acceleration in the U.S. in the back half of the year, and that should create a fairly supportive market for equities, both in developed markets and I also believe in emerging markets.
What about bond markets? How do you see the bond markets reacting?
The bond markets are likely to remain in an environment where interest rates are muted by any historical comparison. We do expect to see some backup in the long end of the U.S. curve, but you have to put that in context. When we talk about a backup to maybe 2.5%, perhaps 2 3/4 on the U.S. 10-year, but that's still lower than where yields were at the end of 2013. It's important for investors to remember there are a lot of longer-term factors, from a dearth of supply to demographics, to slow nominal growth that are suppressing global bond yields still today.
You know, I want to talk about the emerging markets, and let me get your thoughts on India, because the government has completed a year in office and they're trying to woo investors to invest long-term capital into India, specifically in infrastructure projects, roads, ports, the railways. You know, they're here talking to pension funds, for instance. Do you see that kind of money moving into India?
I think it will. I mean, a number of reasons. First of all, you're in an environment where, because of this low nominal growth world we see ourselves in, return expectations for developed markets are probably lower than they were back when the market bottomed back in 2009. So looking for higher return on equity opportunities, I think, is something that investors are very interested in. Second of all, you mentioned infrastructure. We're in a world of low bond yields.
Yeah.
And for both institutions and also for individual investors, finding other sources of income is a top priority. So thinking more creatively about opportunities both inside the United States but also abroad, I think, is one of the considerations that investors should be willing to make.
You know, this contest between India and China to try and attract capital flows, and we've seen the Chinese markets rally significantly, and there's a lot of talk on whether money out of India is flowing into China, so people are booking profits in India and investing in China at this point in time. But how do you read the rise in equity markets in China and the IPO pipeline as well?
You know, China, I think, has been a very different phenomenon and maybe somewhat more troubling. We've seen a significant expansion in valuations in China over the last year. If you look at the Shanghai Exchange, PE multiples are up by about 130%. That has largely been not on strong economic growth, but rather on the expectations for monetary stimulus, for liquidity, and that has driven a very sentiment-driven market. It can go further, and clearly these things often go longer than you'd expect. But the events of last week, where Shanghai and Shenzhen were down 12 or 13%, illustrate that further gains are largely predicated on the continuation of that liquidity. And as the IPO market heats up, as supply comes into the market, you're going to see some corrections as investors struggle to absorb that supply.
But, you know, China's slowing down, whether it's 5.5% or 6%, and the implications on global growth. How do you see that working?
Well, this goes back to the point we were discussing a moment ago, where it is a slower growth world. And certainly China, which has been an engine of growth for most of the past several decades, but we also see slower growth from several other large emerging markets. If you compare the growth rates in Russia, in Brazil, Indonesia, to where they were a few years ago, those markets have also experienced a very significant deceleration. I think in many ways, India stands out as one of the few large emerging markets where there's some optimism, I think reasonable optimism, that India might actually grow a bit quicker over the next few years.
So where do you see money headed? I mean, India is, of course, one of the areas of opportunity because, you know, whether we can argue about 7%, 7.5%, but it's a growing economy at this point in time, and the government is clearly trying to attract capital. But in the emerging market basket, and perhaps even a developed market, where do you actually see money going in?
I think there are a few other places. You know, Japan on the developed side is becoming an interesting story. Obviously, you've got very expansive monetary policy, but there's an argument for being in Japan beyond that. Pardon me, the equity market is cheap relative to other developed countries. You have some reallocation to equities from the pension system. And there has been some improvement in corporate governance, a significant improvement in return on equity for Japanese companies. That's one destination. A second in emerging markets, another country which has really been very aggressive in instituting reforms, is Mexico. And Mexico also stands to be a beneficiary from the energy revolution in the United States. So I think that's another market that really has captured investors' imagination.
Is there a third?
A third opportunity?
Yes.
Well, you know, in the short term, Europe has been the destination of choice. Now, I don't think that necessarily reflects long-term views on European growth, but when you consider where European valuations were a year ago, the very real rebound we've seen in the economy over the past 4 or 5 months, Europe has been one of the more popular investment destinations so far in 2015.
India still looks great. There are very few countries which have the growth potential that India does. So I still remain very optimistic longer term. I think in the next 10 years, this is going to be one of the best, if not the best performing market anywhere in the world. If you look at all the countries in the world, India has the least amount of debt to GDP ratio.
I mean, I think the GDP numbers are complete nonsense, right? In terms of, I really feel that this is the most ridiculous thing that I've seen from any country in the recent past. At a time when the global economy is is growing at a pace of little more than 2%, and the growth rate in emerging markets has halved from a rate of 8% at the peak last decade to less than 4% just now, and ex-China it is just 2.5%. To claim that the Indian economy is growing at 7.5% is absolutely ridiculous.
Real difference in the last 12 months has been that when the Prime Minister took over, basically India was, in our view, a relatively weakened economy. Fast forward 12 months, you have investors with a mixed bag of feelings. I mean, some of the momentum investors are out of the market, some have made money, they are the long-term players like us. But in the meantime, the economy has got much stronger. So whether you look at the current account deficit, the fiscal deficit, you look at inflation, and a lot of other parameters we track, everything looks so much better than it was a year ago.